What's the likelihood that anything like what your committee would like to see is going to happen? I assume it's not very likely.
Well, the whole thing almost ran aground at the end of last year because the French figured out that they were not going to be remotely able to make it, so they were going to block the whole ratio. In consequence, the committee added all of these mitigating features that made it much, much less useful to the extent it ever was. But the U.S. still has a chance to go its own way. And the U.S. does have a fairly powerful voice in these matters because it remains the banking center, the largest economy, and financially by far the most important economy. But whether we will have the courage to do that remains unclear.
Given the rules that the Basel Committee is now looking at, the more watered-down version after some lobbying by countries on behalf of their banks, who the banks may not have been able to meet the requirements. Will what comes out of this in any way, would it be able to prevent the kind of crisis that we had last
Almost
time?
certainly not. The problem with these very detailed measures is that they really invite regulatory arbitrage. And they affect bank behavior in ways that are not always predictable, but almost always undo the intent of the ratio. So we're kind of fooling ourselves to have something we think out there that is going to be a protection, which really doesn't afford much of a buffer at all.
Okay, so 20 countries sat down, roughly 20, under the Basel umbrella and said, we want to come up with ways to prevent the kind of financial crisis that happened last time, and in fact, they're not coming up with a way that would prevent the crisis.
Well, if you were more optimistic, you would say this is the first step on the way to finding a way to deal with liquidity. And it is true that they'd never really explicitly dealt with liquidity before. And it probably was a good time to think about it. But I don't think what they came up with was going to be an answer that will be very helpful.
Okay, so they watered down liquidity rules, no pun intended.
Yes.
And they also pushed it out to where full compliance is in 2019 or so?
Yes.
Which means we better not have another problem over the next
For sure. They're counting heavily on the fact that everything is all fixed for the moment, which certainly doesn't look so likely in Europe. But what they've done, as they have in several other things, is to give very generous phase-in periods so that any bank that is inconvenienced at the moment will have a lot of time to adjust. So I think the rule is currently written, and this also is one of the softenings that took place in January, so that banks have to meet 60% of the ratio, I think by 2016, maybe 2015. I'm sorry, and then they have to do another 10% a year, so it's about 2020 before it happens. Now that has two implications. One is the inference you made, that if something happens in between, we're in trouble. But the other is a political factor. The more time you have in these phase-in periods, the more lobbying pressures you have for further softening of the rules. They're not likely to get tougher. They're only going to get weaker.
So the new rules are highly unlikely to prevent the kind of crisis that we saw last time. Do they offer anything? In other words, do they at least serve as an early warning system? Might they help set off some alarm bells, canary in the coal mine kind of thing, that at least would help us to start to whip the emergency action a little bit sooner? Or is this the kind of thing that it just spirals out of control so fast that if you don't have something right away that grabs hold of it, then what happens months later is not very helpful?
You've defined the essence of a liquidity problem. Liquidity is not one of those slow, agonizing creeps toward the edge of disaster. It happens in a flash. And the more dependent banks become on short-term funding, either collateralized or just borrowing in wholesale markets, the more vulnerable they are to these really rapid declines. With the credit side, regulators have a bit more control. They can sort of ignore deterioration in credit, and accountants have been very accommodating in helping that process, so that forbearance is fairly common. But once the market understands that deterioration has taken place and begins to be reluctant to roll over their liabilities, there has to be immediate action, or the institution is simply gone.